Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. All right, so we got through the Meg 7 earnings announcement. I guess okay. A lot of the Meg 7 stocks did get beaten up, and it was mainly because of the spend going forward, trying to become the leader in the AI space. We saw that happen with Google. Google got beaten up a little bit. We did an earnings play around that. Amazon also got beaten up, both with solid earnings reports, but got beaten up once they started talking about their capital spend that's going forward that they're doing on AI. And it also happened with Meta. NVIDIA has been stuck in a rut, just kind of hanging around the 185 level, but eventually NVIDIA is going to be the last one of the Meg 7 to announce earnings. Stock is actually up 6 today. I just noticed that, to be blunt, up 3%. So it was 185. It's now at 191.50. So we will definitely look at a trade in NVIDIA heading into the earnings report. We also see the financial stocks, which I've kind of leaned into a little bit as a flight to quality, if you will, kind of playing the markets. The fact that the skew between the 2-year and the 10-year has widened a little bit has made the financial stocks a lot more interesting, not to mention the freeing up of the markets a little bit with rules and regulations highly anticipated. We're seeing more and more deals get done. JP Morgan has bounced back, but it's created an issue for us because we had to roll our short call option on JP Morgan on our fig leaf strategy that we had on, where we had the deep into money call and sold the short-term call against it. And last week we had the same issue again with FedEx outperforming, and we had to close that position because, well, we trade 3 days a week, and the stock actually skyrocketed through our short call to the upside. We did very well on the position, but we had to close it. Now, I always want to emphasize that nothing's meant to be a recommendation, and we're going to keep speculating on some earnings trades. We learn a lot about option pricing by looking at, how they move around earnings. So the two stocks that I chose this week go kind of along with the flight to quality, if you will. McDonald's has always been a well-run company, and they're going to be announcing earnings on Wednesday. And then we've seen kind of a resurgence of Coke, symbol KO, Coca-Cola. So that they're going to be announcing tomorrow. So I'm going to do 2 bullish trades on them. Both of the stocks have gone through a period of consolidation and now seem to be breaking out to the upside as money's become more diversified out of the Meg 7 stocks. And that's kind of where we see. We also have Coinbase is going to be announcing at the end of the week. We might look at something in Coinbase, but I was surprised to see during the Super Bowl, and happy Super Bowl, everybody. Congratulations to all of the Seattle fans out there. But with that said, Coinbase did have an advertisement in the Super Bowl. So I was kind of surprised to see that. They're going to be announcing earnings at the end of this week. That stock's really been beaten up, mainly because as crypto goes, so do the exchanges that trade crypto. And Coinbase is one of the bigger exchanges that actually trade a bunch of cryptocurrencies on their exchange. Okay, so let's go to the Tradier Pro software. We're inside the paper trading platform. So we're going to execute these trades today. We see McDonald's trading right now, and I'm showing. And if you do have any questions, by the way, before I jump into this, please do put them in the chat box. Happy to address any questions that you may have. 1 second here. Yeah, there we are. Okay, I got my chat box opened up. You're more than welcome to participate. We want to make this as much of a group setting as we possibly can. So I like to take all your questions, try to keep them, based off of positions that we've talked about here. But if you have a random question or two, I don't mind trying to address them. Okay. McDonald's, $325.08. Look, it's not the expected move in McDonald's. Because it's a fairly expensive stock. implied volatility isn't that great, right? And you can see that this is one of the things I love the most about the Tradier Pros software in general is their option chains, and highlight the fact that earnings are happening this week. And also that we have the implied volatility at 37% and the historical vol is 21. So it definitely spikes ahead of earnings, but it's not ridiculous, right? We even going out to the February, one expiration away, and the at the money implied volatility is trading at 26%, and then we're almost back to normal by the time we get out to March. So in the short term, this is a big implied volatility number. We're going to do the February expiration. No, actually, I'm sorry. When we look at Coke, we're going to do the February. McDonald's, we're going to look at the February 13th expiration, and we're going to stick with our butterfly strategy. I like the way that it plays out. They're announcing on Wednesday before the open. You got all day Wednesday, all day Thursday, all day Friday before that Friday expiration. So once again, this is a speculative trade. It's really based off of earnings. And I think I had McDonald's up in my last. Good, I did. All right, so here's my McDonald's chart. And you see this. This is what I mean. This is a fairly wide swath of trading, this area consolidation in McDonald's, all the way up from 320 to 295. But you do kind of see the wedge pattern, right? In that lower, higher high, higher low, lower high, all the way down to here and all the way through here. And we finally had a break out of that pattern. So I hope that the upside momentum continues. And because of that, we're going to take advantage of the fact that we got pumped up implied volatilities on a fairly expensive stock that allows us to have a shorter term expiration. Now, they're going to announce on a Wednesday before the open. I would prefer it to be Thursday. So there's only a couple of days left in the expiration date, but we don't have dailies in the single name stocks. And I'm okay with that, honestly. A stock like McDonald's is a great example. It's a fairly liquid stock, but you still have fairly wide bid-ask spreads. But it does well when you don't have dailies. You add the dailies, you end up with wider bid-ask spreads on all options across the board because the dailies are going to take some of the volume away. So I like the fact that in the single stock names, especially in the mediocre liquidity stocks like a McDonald's is, that we don't have the near term daily expirations. All right, enough said. Let's go back and look at our trading. See that little breakout to the upside. We're hoping that stays. We're going to do the nearest term expiration, and I've already added it to the what if calculator. So let's go. We're going to go out to this expiration. Let's add it to the ticket. So we're going over to the Tradier Pro what if calculator. We are long McDonald's butterflies. What we're looking to do. This is going to be an official paper trade for today. We're going to try to execute it in the paper trading platform. I'm going to send this to the ticket. Once that goes to the ticket, it's going to be inexpensive, which is nice about a little less implied volatility. You have the pumped up vol, which makes things a little bit cheaper, but it's not ridiculous, right? Mainly because it's McDonald's. McDonald's the volatility was there, but it still doesn't trade at as much volatility as the hyperscales, if you will. Hyperscalers. Okay, 330, 335, 337.50. Okay, so this is an open wing butterfly. It's an alternative to a long call spread. The market goes above our farthest out strike, if you will, the 337.50. This trade will still be profitable. So here's the way it works. Here's the market, 325.06 right now where we're trading. We're going to go a little bit out of the money. I already looked at what the expected move was. The expected move was $10.58, which means, once again, you just look at the most at the money straddle for the nearest expiration. And that happens to be, if you bought the call and you bought the put, you'd pay $10.58. And that puts us at the 335 strike. So If we're doing that, that means our total risk on this trade, if we got this done, is going to be $1 or $100 per 1x2x1 open wing butterfly. The difference between the strike from 330 to 335, that's our long call spread, that would be 5 points. And then from 335 to 337.50 is 2.5 points. So anywhere above and beyond our last strike, this has to trade for around $2.50. We paid $1 for it. That means our maximum upside is $1.50. If it goes beyond the 337.50 strike. Stock stays in the middle. We'd like it to finish right here. And it highlights inside the what if calculator where that profit is at. So 5 minus 1 is 4, but it's showing, I don't know what it grabbed when we came in here. It's showing 428. That would imply that we got it for less than $1. But yeah, it's going to be right around $1 is where it should be, because we're looking at 107 now. Yeah, right around $1. So $4 if we go out right at that strike, right at expiration, which, it's highly unlikely, but we could obviously, we would like to land somewhere within this range. And I haven't shown this in a little bit, but if I take the profit and loss, I'm going to pull this down and we move the profit and loss calculator. This kind of shows you what happens with implied volatility. This is as of today if we put the trade on. And usually, McDonald's is Wednesday morning, Coke is tomorrow morning. So you probably wait to put the trade on tomorrow. You'd use the same type of dynamics to set it up. But if you're truly making it an earnings play, you would set it up the day before the announcement. Just an FYI. But we are not going to have a show tomorrow. So to go along with this, it's Monday the 9th. Let's move it all the way up to, we're going to have the announcement, which is going to adjust it. We're not going to be adjusting the implied volatility, but we'll go to Thursday, and we're looking at Friday the 13th. And you see how this moves. So it moves a lot. Now, implied volatility would also drive this, and we expect implied volatility to come in after the earnings report. But then you're going to go to Friday at this time on Friday, 10:58. And we get to Friday the 13th, interesting enough. But if we get to there, then this is where that expiration is at. And then one more click, and that next half a day, boom, we got to get all the way to there. So don't expect a lot of movement. Well, if implied volatility comes down, it will help a little bit more, but you don't expect a lot of movement until the very last day on these fairly expensive stocks that are trading options around earnings. Implied volatility coming in will also help on the trade. But if the stock goes all the way up, I kind of like this trade, because if the stock starts coming back down, it allows you to stay in, and hopefully you can land in this range. So our ideal situation would be that the market opened more than the expected move and then started coming back down and landing within this range. And then as the stock comes down, we got the potential to make more on the trade. But if it stays and continues on up, we're doing just fine. Only downside is if the market actually goes south. And then if that happens, there's not too much you can do on the trade. So realize that whatever you invest on the trade, if you are wrong, if after earnings that's perceived to be bad news, the market goes down, you're probably going to lose the dollar on the trade. That's the way to approach it. Usually if the market's down after the announcement on Wednesday, I just get out of the trade, try to salvage something as quick as I can. Usually by 10 o'clock, markets opens at 9:30 Eastern time. And that's usually the way we look at the trade. So let's go and put it in the what if calculator, or I'm sorry, let's put it in the options grid. The 11th expiration. There we are. There it is. Now it popped up. The 4th. I'm sorry. I keep getting the 11th is going to be Coke. So I keep mixing the two up. 330, 335, 337.50. Hoping to lean into the upside on McDonald's, and also look at, we made the breakout. Will this earnings report continue that momentum to the upside, and we see the flight to quality afterwards, after their earnings announcement? All right. Any questions on that? And I see you in there, Kurt. Hello. Good morning. Good morning. Any questions you have on these trades at all? All right. Let's run over to Coke. So on Coke, I'm going to just straddle the stock, and here's why. So I'm going to send this to the ticket, and then let's go and look at Coke here. Take a quick peek at Coke. We're going to go to the February 11th expiration, and we're just going to straddle the stock on Coke. Now, Coke is a $78 stock as opposed to a $325 stock with McDonald's. Implied volatility is a little bit lower. Well, actually, it's fairly close, but just a smidge lower. 34% on the front month. We're going to be trading the next week out. We're going to look to the 11-day option contract that is the February 20th expiration. 25% implied volatility. And we're just going to make this a 50-50 bet in this instance, in that we're going to go about 2 points in the money, and we're going to go about 2 points out of the money. Now, the market isn't behaving. It came down a little bit from when I set up the trade, 181, but I don't mind it. So we're 4 points wide. We're going to pay $1.80 to hopefully make $2.20. The width between the strikes minus the 180 that we paid for it. All right, let's see if I send that to the what if right now. And then that should highlight that, okay? So on the downside, yep, there we go. We got the 180 right on. So if the market goes down after their earnings report and finishes below 77, we're looking at $1.80 or $180. On the way up, above 81, maximum we can make, and I'm going to highlight it right here, right? 220 is $4 minus 180 or 220. And then that's our maximum on the upside. This is the profit and loss graph right now. We would do this trade today because they're going to be announcing earnings on the open tomorrow. And this won't show the implied volatility crunch, but so you go Tuesday, just watch how this moves. It's going to move slow to start, and we'll go to Friday, okay? Now we move a little bit more, and then we got next week. So now we got one more week. Going to hit it again. Now you're going to see this move quite a bit. We're going to go all the way to Thursday of next week. And now we're starting to morph into the expiration profit and loss graph. So we're going to go out a little bit more. We're going to give it a little bit more play. If the market, meanders lower, because it's not that the expected move actually is only $2.30. I should have said that at the beginning. That's part of the reason why I don't really need to do a butterfly here. We're just going to do a straightforward bull call spread and straddle the underlying stock. So let's go back to the Coke vertical inside the trading tab. And here it is, still at 180. That's going to be, I guess, the official paper trade. I like the McDonald's one a little bit better, but Coke did really well after their last earnings report. As a matter of fact, we had a breakout in Coke. So here is this kind of the chart that we'd like to see in McDonald's is where we're at. Pepsi did well too. So here was kind of the wedge pattern that had started, and here's the period of consolidation, and boom, we had a strong move to the upside. And I'll grab this right in here. And we hope that momentum continues. So we got all of our ducks in a row. We had the 20-day crossover, the 50-day, and then we got the 200-day down below. So we're showing some strong chart fundamentals as far as Coke is concerned. You're worried that it was a little bit overdone through here, but that's why we're going to give it a little bit more time. Even if we get a little bit of a pullback to start with, we got another week for it to kind of bounce back a little bit on that trade. 180 for the trade versus $1 for the in the money McDonald's trade. But the McDonald's trade, we need the stock to go up in order to get to break even. At Coke, all the stock has to do is stay where it's at, and we're at break even. You take 77 plus 180, that is 78.80, and right now the market's at 78.15. So we're very close to getting a break even on Coke, and hence so it changes the risk reward a little bit. So because of that, you usually pay a little bit more. That's straightforward. All right. Okay, Kurt. Thank you for the comments. I think I like the McDonald's one a little bit more than the Coke one, but there's also another situation that I have to deal with. All right. Here's my portfolio, and I'm going to be done here in a little bit, but JP Morgan, we rolled, and unfortunately, we are still getting strong movement to the upside. I really would have liked it to take a little bit of a break. We got 18 days remaining. We went as far out and as far up as we could and get it done for a net credit. But we're now at 325 again, and we're 56 cents in the money on this option contract. And once again, inside the Tradier Pro software, we're highlighting that. So our deep in the money call is, hanging in there, and we need this option contract to expire, and it's not playing the way that we want it to. So we're going to have to take this and roll it again. So I click on the lightning bolt, and I click roll, and we're going to have to roll up and out again. So this instance, we're at 325. We want to get it done for a net credit. This is 306. Let's try the 330 net debit of that. We're going to probably have to go out to April. 520. That's huge net credit. Okay. That's a good sign. So let's look at let's look at 320. 155. Well, all right. So we're getting decent rolls. If we roll from the 325 to the 330 and we go out to the 320 expiration, March 20th, we can bring in a net credit of $1.45. So that's not bad. But I don't want the credit. It's more so I don't want the cheese anymore. Just let me out of the trap. I want to try to get this roll done and get it over with. And then we try to capture the gains on just overall on the position if we can roll and get it done for a net credit. The reason why we can get it done for a net credit is we're doing a preemptive roll in that. We're not letting this option contract get that deep in the money. So if we do the 27th, no, that's too short. It's got it 306. No. 13. That's the magic number. All right. 38 cents. That's what we're going to do. We're going to go out to March 13th. We're going to try to get this done for a 38 cent net credit. Once again, we're in the paper trading app, so the midpoints are really hard to execute in here. We'll go, and I'll put it for 30 cents, and I'll send that to the floor. And here we go. All right. Behind my head, it says that we sent to the floor the roll of our short option contract on JP Morgan. And then I did say we're going to execute these other trades, and then we'll call it a day here. So let me go in and send the trades so that we got something to look at Wednesday. What if calculator? Let's send a ticket. The Coke trade, 175. So once again, we're going to have to pay up a little bit, probably 185. Send that to the floor right in between the mid. So the ask is 195. The mid is 175. We'll go right in between the mid and the ask. And we're going to send that one to the floor. And there it goes. And then we got our butterfly in McDonald's. Need to grab this one and send it to the ticket. Got to have these box checks. You send it to the ticket. $1. I really wanted to pay $1. I like that. That was nice, but we're not going to be able to in this paper trading app. So we'll go 107 is now the mid. We'll go one. Gosh, we're probably going to have to pay 130 in here. Okay, 130. Man, that makes me sad, but I think that's what we're going to have to do. Let's see if we can get that filled, if we give them that much inside the paper trading app. And once again, we're in a paper trading app, so it's not really going to the market. There's not real market makers that are taking the other side. There's algorithms that determine like, well, this is where we should be able to fill the trade, but that's never as good as the actual fills on the marketplace. At least in my experience of using this. All right, so we have our 3 trades in. The most important one that we got to get done is this roll of JP Morgan. We don't want to get deeper into money on our 325 call. And then, but these are our fun trades around earnings, Coke and McDonald's that we put together, and I'll make sure they get executed, and they'll be in the positions on Wednesday. And we are right at time, 25 minutes, as I mentioned. So thanks for coming to Options Guy TV. We'll come back on Wednesday. We'll look at a few other trades at the end of the week. Coinbase is around. I'm not too excited about Coinbase. I mean, Bitcoin is still struggling, even though Coinbase does well as far as their earnings are concerned, because the more trading that goes on, which has happened with the decrease in Bitcoin, there's a lot of people rushing to get in and out and speculate on the positions. So the trading volume is there, and they're an exchange, but the stock price always has a tendency to follow whatever Bitcoin is doing. So Bitcoin's down, Coinbase is down. So I don't know if I really want to trade that going into earnings, but we got a few other stocks at the end of the week. So come back on Wednesday and we'll have a couple for you. And thanks again for stopping in to Options Guy TV. We'll see you Wednesday, 11 a.m. Eastern time for the next edition of Options Guy TV inside the Tradier Hub. Hope to see you.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.